Welcome back, everyone. Today, or in these set of videos, I should say, we will start looking at Chapter 2 and recording business transactions. But before we dive into that, I want to just go through a quick couple reminders from Chapter 1. Just a few fun reminders. So number 1, remember that the balance sheets must balance. And here's a quick, fun reminder to help you remember this. So why did the ghost stumble home on Halloween? He was wearing an off-balance sheet. Ha ha ha. You guys will learn that I love puns. That's the kind of joke that really cracks me up. So you'll maybe see a few accounting puns. They're best kind of puns out there. Okay, so next quick reminder. The question, why do we prepare financial statements? And remember, we talked about this. We're doing this to provide useful information to decision makers. So there's so many different users. We need to make sure they've got useful information so we don't fall into this situation. It is a statement, John, but technically we're in deep bleep is not a profit or loss statement. So this accountant, he's clearly not as knowledgeable as you guys already are. So he didn't know how to prepare the proper income statement. So now you guys have learned that and we know how to keep rolling. All right, so just a couple jokes. Now we will get into Chapter 2. These are the 9 steps of the accounting cycle. And this is what we'll cover in the next few chapters. And overall, what we're looking at in this course. So today in Chapter 2, we're going to look at the first 4. We will identify and analyze transactions as they occur, record these transactions in a journal. We will then post or copy from the journal to our ledger accounts. And number 4, we'll prepare an unadjusted trial balance. So I know these terms right now don't mean anything, but that's what we're going to start by looking at and what we'll go through in these videos. So this is just another look at the accounting cycle that the textbook uses. It shows that they go in order. At the end of the year, we have this final trial balance, which then is the opening balance that we use when we start the next period. So this accounting cycle is done for a full period. And typically we'll do this closing process at the end here once a year. So we're going to go through a full year, what these steps look like. Okay, so learning objective 1, we're just going to go through a few terms before we get started. So first off, we've got an account. Now these are all of the different items that you see on the financial statements. So we did speak about a lot of them in Chapter 1. For example, cash is an account, accounts receivable, sales revenue. So they're all of these different items. They each are called an account where we track the information. The chart of accounts is the list of all of the possible ledger accounts, even if they don't have a balance. So we won't really use chart of accounts in our course, but in real life, businesses typically set up when they're starting. Here's the possible accounts that we think we're going to use. And they're all listed there to be chosen from when you're doing entries. For our course, we're not really going to have one. You guys will be able to come up with these accounts. So the journal, sometimes referred to as the general journal, this is going to be a chronological record of transactions. So all of the transactions in date order. The ledger is a copy of the amount or the items from the journal, but now they're getting broken up by account. So we'll go into this in more detail in a bit. I just wanted this kind of summary slide in here. So once we go through the chapter, if you guys are looking back and studying, it's all in one place. But we will dive into this more in the future slides. And then lastly, a trial balance. So this is a list of all of the ledger accounts and their balances, and it's at a specific point in time. So typically we're only looking at accounts that have a balance, not ones with zero balances. And that is the difference between the chart of accounts and the trial balance. In the trial balance, we actually show the dollar value balance at a point in time. The chart of accounts is just a list of all of these accounts. There's no balances shown. Okay, so that's just a quick look. As I said, still probably a bit unfamiliar, but we'll go through these with each step that we look at. Okay, so step 1 in the accounting cycle is analyzing transactions. Now, when we look at a transaction that occurs, we're going to look at accounting that is based on this double entry system. And this tells us that there are always two sides to a transaction. And because of this, every transaction that we have will have at least two different accounts. It could be more, but always at least two. And that's what we'll start with. So when we figure out that a transaction has happened, when we analyze this in step 1, we need to first identify the accounts impacted. So what accounts are affected because of that transaction? And secondly, we're going to identify if the accounts are increasing or if they are decreasing. And that's really it. The textbook goes into a lot of detail on this, but for our purposes, this is kind of what we're going to focus on. And then we'll look in more detail once we get to the journal entry portion. Okay, so let's go through an example of analyzing these transactions. So for each of these, we're going to ask what accounts are impacted and do they increase or do they decrease? So the first one, a cash purchase of inventory. So we buy some inventory and we pay for it with cash. So what are the two accounts that are impacted here? Right, the first one is cash. So we're using our cash to buy something and we are buying inventory. So that will be the second account that's impacted. Now we need to decide if each of these increased or decreased. So cash, we are using it to buy something, which means our cash is going out. So this is decreasing. We're spending our money. The inventory, we're buying that, so we are receiving that amount, and therefore it is increasing. So step 1 is really just thinking about these things. It's not super accounting-like, it's just kind of common sense, reading the transaction, what's going on there. The second example, a purchase of a truck made through a bank loan. So again, we're buying a truck. Well, that's increasing that amount. So our truck account, or potentially called vehicle, it would increase. And we now have this new bank loan. So a new amount that we need to pay to the bank. So the account would be called a bank loan payable, because it's something we need to pay in the future. And this is a new amount, or in addition to an older amount, but it's adding what we owe. So it's increasing this amount. So if you were buying a truck and you went to the bank to get a loan, that payable balance goes up. It increases. And that's really it for step 1. We just have to figure out, okay, what accounts are impacted? Do they go up or down? And to note, if you're doing a question in the textbook, this isn't something you actually have to write out. This is more just a thought process. So what transactions are occurring and what accounts are impacted? Do they increase? Do they decrease?